over the income statement and all the line items in the income statement. So, okay, what exactly is the income statement? Income statement is one of the core statements out of the three. So your balance sheet, your income statement, and your cash flows, that are typically looked at the most when it comes to analysis. Okay, so before we actually get into any analysis or any income statement related type of work, I want to introduce you to three different shortcuts. The first one, which is very useful, is Alt Tab. Okay, so you hold Alt and you just press Tab. And what does that do is that it lets you kind of surf through all the apps you have open, or go back to your desktop. Okay, so that's one. Alt, you hold Alt and you press Tab. Okay, so you do that the whole time. It's very useful. Then second you have is Control Page Down, or Page Up for that matter. What that does is, let me move that to the top here. What that does is, okay, I think it's better off having it right here. Okay, what Control Down does is that it switches through tabs at the bottom, as you can see here. And let's say you want to move backwards, so you press Page Up. So hold Control and Page Down will make you move up. Hold Control and press Page Up will make you move backwards. Okay, so Control Tab is to change between applications. Control Page Up or Page Down lets you surf through the tabs. Okay, and the third and the final, I think we're gonna use the most, is Control F, which is Control F means that to find information. So this comes very handy if you're dealing with documents that are at least 100 pages long. Let's say you want to find non-recurring items. So you just put the word non-recurring, or maybe not that, maybe not non-recurring. Let's say basic. Let's say you're trying to find basic EPS. Let's press basic, and we have everything that includes the word basic. Okay, so this comes very handy when you're trying to find non-recurring, unusual, one-time charges, or in general just finding basic items on the list. Along with going in the income statement, towards the end of portion, such as your EPS, we're gonna be we're gonna be leaving the income statement for a bit to find this information to kind of completely finish off the historical place, or the historical segment of the income statement. Okay, so this is how your income statement looks like. So you should have this pulled up. Already did the first two years for you guys. You probably don't have it on your income statement, and the reason I don't have it is just so you can practice with those 2 years. But the 06 I have to show to you guys, because this is where the first call consensus comes into play. So that's how I'm gonna do I'm gonna do the 06 with you guys. Okay? But before we start, let's make sure that we know each of the line items. Okay? Let's say total revenues. Obviously, total revenues, also called net sales, is basically the money that you earn by selling the products or services that your company has. Okay? Easy. Cost of goods sold. Cost of goods sold is basically the amount of products you sell. What was the cost to produce those products, or what was the cost? Yeah, what was the cost to produce those products? Okay, this cost, each product has somewhat of overhead, manufacturing overhead considered into. Also has some fixed costs, some variable costs kind of considered into as well. And altogether, cost of goods sold are basically that, and you subtract that from your revenues. Okay, when you subtract that from your revenues, you get gross profit. I know we don't have it up here, but certain models have gross profit, which is total revenues minus COGS, or cost of goods sold. Okay, now before I jump the gun, you'll see cost of goods sold, pro forma, and reported. Right now we're just going to put the numbers into the reported. We'll worry about the pro forma later, once we're normalizing the income statement or pulling out the non-recurring items. Okay, so we have total revenues, or net sales, which are money earned from selling our products or services. Cost of goods sold is basically the cost that each product that each incurred whenever you sell each product. That's called cost of goods sold, right? Now, let's just say that you have a service-based type of company. For example, you have consulting, or you have insurance. Well, not insurance. You have financial services, right? You'll have operational expense or operating expenses rather than cost of goods sold, because you're not dealing with products anymore. You're dealing with services. So under operating expenses, you have traveling expenses, uh, certain things like that counted into that deals with day-to-day operations. SG&A expense is selling, general, and administrative expenses. These are expenses basically related with the salaries of an executive at the company. Okay, certain things like that are counted into the SG&A. And then you have other incomes and expense. As you can see, we lumped SG&A and other together. In certain models, you'll see that SG&A and other are some lumped up for certain reasons, probably for simplicity's sake. But in the income statement, as we're going to see, usually these items are separated. I don't know why, but they are. So we're going to take SG&A and other, we're going to add them together. So sure, SG&A kind of deals with salaries, maybe deals with a lot of administrative work, maybe advertising campaign will be considered into this expense. But what does it mean by other income and other expense? Well, when you don't have anything that fits into COGS, SG&A expense, or operating expense, whatever cost is that miscellaneous cost is going to be counted into other income or other expense. That doesn't necessarily mean that it is non-recurring. It's just that we can't topical those expenses or group those expenses with these topics or these sectors, I guess. Or, yeah. Okay, so that's our COGS, SG&A, and total revenues. Okay, so operating EBIT, or operating profit, or also called EBIT, earnings before interest and tax. Okay, this is basically calculated by taking your total revenues, subtracting your cost of goods sold, and subtracting out your SG&A. Now, when you subtract out cost of goods sold from total revenues, you have gross profit, right? So you can also say gross profit minus SG&A and other as well, whatever works well for you. So that's what we did over here. Okay? Interest expense. Interest expense is basically the expense that you incur from pulling out loans. Okay? Obviously, these are loans that you have to pay within the year. Accounts payable to pay off your suppliers. Probably the current portion of long-term debt. There's probably interest on that you probably have to pay. That's what interest expense is. Just expense accrued from having loans. Non-operating income loss. Non-operating income or loss is basically any income or loss that is not attributed to the company's performance. Okay, for example, if you are a company that sells widgets, a non-operating income for you would be that you have taken some of the proceeds and invested into the stock market and you had return on them. That's called non-operating income. And the reason it's called non-operating income is because that particular income is not the main source of income for your company. It's non-operating. That means even if a company does not operate, this income can still be this income may still come in. Non-operating loss can be probably, I'm trying to think of one. Okay, but it could probably be a loss in the stock market. When you invested into the stock market with some cash that you had left over and you had a loss, you had a negative in the market, that could be non-operating loss as well. Reason being that loss is not that loss is not because of the company's main operations, rather than just side operations, or that's kind of used to kind of make money off of money type of thing. Okay, so once we have found our interest, non-operating income, and loss, we can take our EBIT. Okay, we can subtract our interest expense, and we can add back our non-operating income. Okay, and then we can that's what we can do, and that's what we have here. Okay. As it gets here, we can do the same thing over here. Now, okay, so we have our pre-tax income. Okay, now it could say pre-tax income. It could say income before tax provisions, or it can say, just EBT. I never saw that one before, but probably you can have EBT, which is earnings before taxes. You're gonna have, then after that you're gonna tax it. So tax reported. Okay, these are taxes, basically just the taxes that you pay, the income taxes that you pay. Okay, equity and income affiliates and after tax. Now this is a little confusing, so I'll try my best to kind of explain to you as much as possible. Okay, let's just say that you're a owner of Walmart. Okay, you are a CEO of Walmart, and you made a plan that, okay, I want to invest 20% of our capital into other super grocery stores, such as Target, or not, that's not a grocery store, such as HEB. Okay, we decided to have at least 20 to 25% worth of ownership into that company. Now, what we are considered to them is equity, income, and affiliates. Okay, because no, actually, I'm sorry, it's supposed to be the other way around. Equity, income, and affiliates are basically when. Well, I'm trying to get this right. Yeah. Okay. So I was right the first time. So let's just say you're investing 20 to 25% of your capital into HEB. You are considered. They are considered equity and income affiliates. Okay. That means that we have taken our own 20% of our cash, at least 20%. That's always a rule. At least 20%, and put it into HEB. Right. That means we are one of the big owners. We are one of the most impactful owners on the company. Okay, because that's millions and millions of dollars put into that particular company. So obviously we're going to be regarded much more highly, right? So that's equity, income, and affiliates. The opposite of that is minority interest expense. Let's just say that you had HEB that invested 20 to 25%, 25% of their capital into your stocks, and now they have 20% ownership. Whenever you pay them out dividends or any interest, that is called minority interest expense. Okay, so you can think of it as somewhat opposite of the equity and income affiliates. Okay, so net income. So we finally get to our net income, which is basically your pre-tax income. Subtract out your taxes, add back your income, your equity, income, and affiliates, and then subtract out your minority interest after tax. You'll notice one thing. If you look at D35, which is your minority interest expense, we're adding that number when I just said you're subtracting. Well, technically we are subtracting, because whenever you have a parentheses in this box, that means the number is negative, as we can see here. So when the number is negative, we're signifying that we're going to subtract it. As you can see here, enter as negative. Okay, so the only thing we just have to do is add that number, which automatically subtracts it from the number, and you find your whatever you're trying to find. In this case, it's net income. Okay, and common dividends are dividends that are just generally paid. They could be preferred dividends, and they can also be common dividends, both together. So those are your common dividends. Your common stockholder dividends and your preferred stockholder dividends added up together, and that's what we have, your common dividends. Okay? Then once we have figured out our income statement, we'll move down more into calculation-based type of things, and we'll be kind of moving away from the income statement. Okay? For example, we have pro forma EBITDA reconciliation. We're going to get our EBIT, which is gotten from here. So what we do is that basically we take equals, go all the way up here to our EBIT, and press OK. Now, you see over here, depreciation and amortization. What exactly is depreciation and amortization? Okay, let me give you an example. Let's just say that you own a property that has a lifespan of 10 years. You're saying that after 10 years, you're going to sell out that asset. Okay, whether it's the equipment or machinery, whatever it is. Okay, so what you're going to do, you're going to create a depreciation schedule that kind of relates with the value of the product or the machinery throughout the years. So let's just say that you're saying that it's going to be 10% decrease and 10% increase in depreciation every year. You're saying basically that there'll be accumulated depreciation of 10% every year. Therefore, the value of the whole product or the machinery is going to decrease by 10%. That's what depreciation is. We're accounting for that depreciation. Amortization is exactly like depreciation, but it works towards intangible assets such as patents. Okay? So, what is a point for calculating depreciation and amortization? It's not like we're actually accruing expenses, right? These are just non-cash expenses. You're right. That's why we add them to our EBITDA. Now, EBITDA is one of the most famously regarded ratios, even a multiple in some cases, that you'll see in the market or you'll see in general in your finance classes. And the reason why this is true is because EBITDA is used in several multiples or analysis throughout finance. So it's kind of like a common talk when you're talking about EV over EBITDA when you're evaluating a company. So what does EBITDA mean? Well, basically is EBIT. Basically is EBIT plus your DA. So earnings before interest, tax, depreciation, and amortization. This is very important to know since this is the very, very, very basic knowledge behind finance. Whenever this can be something that will be asked possibly during the interview, right? So this is how we find our EBITDA. Our EBITDA we find by taking our EBIT and adding back our depreciation and amortization. Now, what do I mean by adding back? Okay, well, simply, I'm taking depreciation and amortization, as you can see, and adding it to our EBIT. And the reason I'm doing that is because I want to know the operating profit before we took out any money for depreciation and amortization, because we want to see strictly on the cash or credit based type of expenses how much money or how is our performance like, right? So that's what we're basically doing over here with EBITDA in 2004, 2005. And we're going to go over it one more time, go over with 06 and do it one by one so you can understand where I got these numbers from. Preferred dividends. Preferred dividends are basically, we're taking the dividends that we have from the common dividends, okay? Now, when we refer back, what did we mean by common dividends? What we meant was by just common dividends from shareholders, okay? You also add the preference dividends from shareholders, okay? So we're adding two of those together, and that is called common dividends, okay? Whereas over here is asking for preferred dividends, so we're just gonna go back into the report and just find and just exclude everything and just have preferred dividends, as you can see here. Once we find deferred dividends, you find net income for basic EPS. What does that mean? Well, the net income for EPS means that, okay, we want to find the net income for our basic earnings per share. That means we're not counting for any diluted parts. We're not counting for any convertibles. We're just looking for the simple basic EPS or for the amount of shares that we were told that were issued this year. Okay? So that's what net income for basic EPS means. So we're essentially taking our net income number, right? And we're going to subtract our preferred dividends. Remember, the reason we're doing that is because we want to get to basic numbers, and the basic you can get to net income is just counting for common dividends, which is common stockholders' dividends. That's the most basic you can get. As per preferred stock, gets a little bit more advanced for advanced investors. Okay, so keep that in mind. That's why we're subtracting out our preferred dividends, because we want to know how much net income we're going to have, just taking into consideration our common shareholders. Okay, and then we find our basic shares outstanding, which is just the normal amount of shares that they give us in the report. We're going to look for that. And like I said, basic outstanding shares, which means we're not counting into diluted shares or anything like that. Basic EPS. Basic EPS is basically basic earnings per share, and essentially gives us a earnings per share, basically how much money we can possibly make off of each share of that company. Okay, not taking into consideration any diluted shares, preferred shares, convertibles, nothing like that of that sort. Okay, so that's how we calculated our basic EPS. Last but not least, our pro forma diluted EPS. Our pro forma diluted EPS, we are taking our adjustment to net income for diluted EPS. Okay, this is typically shown in the report. As you can see, there's a zero, reason being that we can't find it into the report, and it will strictly say that, okay, we had this much of an adjustment to our diluted income. Okay, so net income for diluted EPS. What's the difference between basic EPS? Well, in net income for diluted EPS, what we're doing is essentially we're taking our net income and we're adding our adjustment to net income for diluted EPS calculation. Okay? And why are we doing that? What's the purpose behind that particular movement? Well, the purpose is basically that we want to know, alright, we found out that on the most basic level, not considering any dilution of any kind, our EPS for 2004 is going to be $2.38. Okay, sure, that probably makes sense. Now, what if we consider, okay, all the diluted forces, such as your restricted stock, such as your preferred convertibles, and etc. What if they were fully converted and added back to net income, and then we're going to be forced to find that diluted shares, because from then on, your whatever company you're looking at, they're gonna have diluted shares, or you already found their diluted EPS. Okay, so again, diluted EPS is compared to basic EPS, and the difference is that basic EPS does not consider dilution of any kind, or does not consider any type of convertibles or preference stock, whereas diluted shares cares about that dilution, cares about the convertibles and preference stock, and we'll see that in a minute. Right here, the next line, stock options, restricted stock, and converts. Okay, what does that mean? Well, now we're taking into consideration, okay, what if we had all the options that we have with our stock options, our restricted stock, and converts, which are also include convertible preference stock. What implication do we have? Well, in order to find out what implication we have to find out how many stocks are going to be purchased or sold back to the community and whatnot. Okay, and that kind of judges, what kind of signifies the power that the company has into the market, just depending on the amount of voting or the amount of support that civilians give. Okay, so now diluted shares outstanding is basically your basic EPS. Your basic EPS. Let me move up a little bit. Okay, your basic EPS. I'm sorry. I don't know why I'm saying basic EPS. I meant basic shares outstanding, which we see over here. Remember, because it's not considering any diluted, adding all the dilutive implications, such as stock options, which are obviously options given to employees in their benefit packages. Restricted stock, used to kind of give to people that have loans, that pull out loans for the company, such as mezzanine loans that have also ownership and debitor to the particular company. And you also have convertibles, which is convertible preference stock or liabilities or loan for that matter. But in this case, we only are dealing with convertible preference stock. And what we found was that that we did have some convertible preference stock. We added it in here, and then we subtracted it. We added it to our basic EPS. Our basic earnings per share. The outstanding shares. Sorry about that. This is very late. It's like 12:30 right now. Okay, so diluted EPS. So how do we find diluted EPS? Easy. We just take our net income diluted diluted affected divided by our diluted shares outstanding, and we get our EPS for that particular year. Now, if you notice, if you compare that to the EPS of last for the basic EPS, you see that this is actually much more smaller, and that's supposed to happen. Reason being that when you take diluted shares into consideration, what happens is that when you're taking a actually, let me repeat backwards. Okay. The reason why that diluted shares is smaller than the basic EPS is that, like I said, the EPS does not take any restrictions, stock options, or convertible preference stock into consideration. What do I mean by into consideration? Well, assume that all of those shares, stock options, they were exercised, and once they're exercised, a particular individual was buying a particular amount of shares into the market, right? That's stock options. Second, we have is restricted stock. Now, like we said, that deals with loans or people that are debtors, such as mezzanine loans. Okay, they have somewhat of an ownership into the market. Third is convertible preference stock. We call it preferred preference shareholders have some kind have a great perk, and that perk is that sometimes companies let them switch over to common shareholders if they want. Okay, so that's called convertible preference. Now, what if all of those preference stock was shifted over to your job next to you, and that job is kind of dwindled away? Reason being that hold on. Oh. Crap. I think I just went into a whole nother topic. I'm like so out of it. Sorry about that, guys. Wow, I need some coffee. Okay, but the whole point, let me just reiterate that point between basic EPS and diluted EPS. And the point I'm trying to get across is that basic EPS does not take consideration into convertible shares and whatnot, whereas we're taking that into consideration with diluted EPS. So let's assume that stock options, restricted stock, and convertible preferred stock shareholders, exercise all their rights, and they all have common shares which are going to be issued into the market. What we have a larger amount of shares outstanding, and what that does, that brings down the overall EPS lower. So you have your income over here, right? You have your income, and after you have your income, you have your shares outstanding. Okay, and a basic EPS, that's what you basically have right here. But in a diluted EPS, what we have is shares outstanding including we have converts. We also have restrictions, stock options, and what happens is basically that the denominator is getting bigger, and overall that brings the value of the overall fraction lower, which means that it's bringing our overall EPS lower. Okay, I hope you understood that. That's a little difficult concept that we need to kind of master. We'll touch on it again. Okay, so that's basically, and for first call consensus, we're not gonna have that for 04 and 05 because we don't need to know them, but we're gonna have that for 06. Reason being that we need to look at the consensus EPS and see the EPS that we do get and compare them to figure out if we have to normalize our income statement or not. Okay? Once we find our consensus estimates, we're going to lay them out over here, and then we're going to find projected. First, then we're going to find our non-recurring items, and from there we're going to go on and have a great time. So before we go there any further, I'm just going to end this video. Reason being that so I can start on a new one and I don't go on for an hour, so you guys get a break too. So on the next video is going to be like the second part of modeling out the income statement, okay? So I hope to see you guys in the next video. Alright, catch you later. Bye.